Folks, this is Tom Nash coming to you from his vacation spot. Even though I wasn't planning to make any videos so far, I've been making them daily. And that's kind of funny because it seems that the minute I leave, everything goes absolutely crazy. In the past week, we have seen geopolitics go through the roof. We have potentially war brewing up in the Middle East. The presidential campaign is now wide open. We have Buffett selling his favorite all-time stock, Apple, slashing half of his position. On top of it, we have unemployment rising to 4.3%, all of a sudden spiking. And the Sam rule, which 50% of you have never heard about, and don't worry, you're in a good company because most of the commentators citing this rule have not heard about it up until a few days ago. The Sam rule, which has a 100% track record in predicting recessions, is now flashing red. So that's a lot of concerns and that's a lot of uncertainty. And the market is absolutely crazy and it's not fun. And I'm here to kind of put your mind at ease because what we're going to do here is not going to distribute hopium and copium. We're going to give you facts and objective data about what's actually going on. We're going to separate emotions from the data, and we're going to work out a plan on how to manage this market. So, not optimal to make a video in a hotel room, no, on a Mac, but it is what it is. What's key here is the information, not the production quality. So, the one thing I've been hearing over the past few days is, oh, Warren Buffett, he knows what's coming. He knows what's coming. And the other thing I've been hearing is, well, the Sam rule has never been wrong before. It has 100% accuracy. So if Warren Buffett now selling, he's at all-time highs with cash, and the Sam rule got triggered, and all this thing just crashing down upon us, we must sell and liquidate our portfolios. Okay, so a little tidbit of information here before we start the video. The famous study I keep quoting about the 1%. Remember that study? What the 1% investing strategy looks like. So the one interesting thing about it that I keep explaining is, back in 2020, when a lot of people were certain that the world is coming to an end and the market initially plummeted in the beginning of the pandemic, right? A lot of retail investors sold out of the market and missed out on a massive rally. Well, you know how many of the one percenters actually liquidated their portfolio in 2020? 1%. And it's kind of funny, only 1%. So 99% of the top investors in the United States have not liquidated their portfolio in the face of Armageddon, what seemed like Armageddon in 2020. So that's an important lesson. Another is that these guys don't really actively trade in and out of positions. It takes them 12 years to trade through their entire portfolio. So the two conclusions here is, number one, stay stoic and relax in the face of Armageddon. And number two, don't overtrade your portfolio. And that also kind of goes along with that study of, if Fidelity kind of did a study about their most successful portfolios of all time, and they found that the top performers were dead people who didn't touch their portfolio for years. So that's besides the point. So let's talk about what's going on. Number one, thank you for all the people who joined the Discord over the past few days. Thank you for the 18,000 people who have subscribed to the channel over the past 30 days. That's really exciting. Thank you to all the new Academy members we've seen join over the past 24 hours. The Academy is now locked again. You cannot join until September 1st. I'm sorry. The join rate is just too quick. We need to adjust before we accept new members. So let's separate the emotions from the facts here, because that's the most important part, in my opinion, of what the work I do here on this channel. You see, Buffett sold Apple and he sold Bank of America stock. Apple was his biggest position by far, with 40% of his entire portfolio, which is absolutely mental. And Bank of America was his second biggest position with about 12%. So him selling these two biggest holdings, it's massive. It's significant. I agree. And now the one thing I want you to remember is, number one, Buffett is on record multiple times over the past couple of decades saying that he doesn't like holding too much of a specific individual stock. It's not a good idea. Having 40% of your portfolio in one stock isn't Buffett's style. On top of it, he also talked about the fact that this specific sale is mostly tax driven. And whether he's lying or not, I don't know. But the one thing I can tell you is that I've worked with some of the richest people in the world. I was a financial advisor, a senior financial analyst for many, many years. I worked for Deloitte as a senior manager. I've I've had a chance to sit across some of the smartest, richest people in the world. And the one thing I can tell you is that people buy stocks for one reason. They want the stock to go up. There's no doubt. But selling a stock can be driven out of a bunch of different reasons that are not necessarily that the stock is bad or the market is crashing. Selling a stock can be tax driven, it can be risk management driven. There's a lot of caveats about selling a stock. So that's why they say there's only one reason to buy a stock, and there's literally 1,000 reasons to sell stock. So the mere sale here of Buffett, of Apple, and Bank of America in itself isn't really an indication of anything. And I'll go a little bit deeper into that in a second. I just want to point out one thing here. Look, guys, year to date, which means from the beginning of this year until now, the S&P 500 gained 13%. It's currently sitting 5% below its all-time high. At the same time, while Buffett was selling, Apple actually increased its value by 30%. So Apple had a massive quarter, while Buffett was selling. So it's not like he timed this very perfectly. It's currently sitting at pretty much very close to all-time highs. And the fact that Buffett missed this rally and he missed out on a lot of upside isn't really the point I'm trying to make here. That happens sometimes. That's part of the game. The point I'm making is that the stock, despite Buffett dropping 75 billion into the market, really didn't move. So, what gives, right? And the one thing I want you to think about, it's a zero sum game. So if somebody dumped $75 billion of Apple stock on the market within a single quarter, and the stock didn't move, in fact, it had a 30% quarter, it rose by 30% while this was happening. That means that somebody purchased this $75 billion worth of stock. So that means that demand was high. And if you think that stupid retail investors, and when I say stupid, I mean stupid retail investors bought $75 billion worth of Apple stock while he was selling, well, that's just not the case, because 80 cents on the dollar is not retail money in the market. 80% of every single transaction in the market is institutional investors, is professionals, is institutions, is the big boys, is the pros. So while Buffett was selling and selling heavy, the pros, the institutions, they were buying heavy. On top of it, Apple was buying back a lot of shares in that quarter as well. So basically what happened is that Buffett sold 75 billion and a bunch of other institutions and Apple itself bought the stock. And that basically what happened. So if this was a dump and this was, they're super investors, they know, and they're dumping on the other super investors bought it. Apple bought it. So it's not really the case of Buffett dumping and getting out and the market basically saying, yeah, we got to get out, and everybody's following suit. It's not the case. And you see, at the end of the day, Buffett was up 700% on this investment. 700% on a multi-billion-dollar investment over a long time. It ballooned to half his portfolio at some point. It just doesn't fit the Buffett approach. Having 50% of your entire portfolio in one stock with a 700% built-in gain is just not good risk management the way Buffett likes to run his shop. And whether it's Buffett who's making the calls here, or one of his lieutenants or whoever, doesn't matter. The Buffett DNA is what I'm referring to, right? So right now, a lot of people are concerned because they're seeing Buffett or Berkshire Hathaway, right, sitting at $280 billion of cash. That is a record, and that spiked from 200 to $280 billion over a single quarter. And the 200 billion in itself was a record cash position. So Buffett has been in record cash position for the past quarter and a half, 2 quarters. And right now, he's sitting at 5% interest with about $280 billion. That is absolutely insane. And so if Buffett is selling and if Buffett is holding record cash, right, he knows better than most of us. He's the super investor, he's the GOAT. So if he's doing that, we must sell because the market is about to crash and Buffett knows it, right? Well, let's talk about it here for a second. Let's be rational and let's kind of relax, okay? So if you combine Buffett selling and the unemployment data, what you get is a lot of recession fears. and people are selling in anticipation of a crash, right? And a lot of people talking about the Sam rule. Basically, the Sam rule, for those of you who haven't heard about it before, and don't worry about it, you're in the good camp. The Sam rule basically says that if you take the unemployment rate, the lowest unemployment rate over the past 12 months, and you look at the 3 month average, and the 3 month average is actually higher than the lowest point by more than half a percentage point, the rule gets triggered. Basically, all it means, if unemployment spikes too quickly, too fast, then it's basically a sign of a recession. And applying this rule all the way back to the 50s, this rule has always been accurate in predicting a recession, either before or after. Mostly the recession was a few months earlier and nobody knew about it. And one time it was a few months later. But in any case, this indicator has never been wrong in predicting a recession. So, with that, and with the Buffett cash hoard and selling of Apple, this means that everybody must sell. That's the narrative you're going to be hearing in the media. And perhaps that is true. Perhaps that is true. Perhaps we're heading to a massive crash, a massive recession, and that's the right time to sell. I just don't know. But here's what I do know, right? Buffett is one of the greats, right? Let's break apart the Buffett stuff and the Samuel stuff, right? Buffett is one of the greats, no doubt, right? But Buffett does not have a crystal ball, and he made bad calls before. In 2022, he sold TSMC. It's done 100% since. He dumped airlines during the pandemic in 2020, 100% since. Same year, sold out of Costco, 200% since. 20 years ago, he sold out of McDonald's. McDonald's is up 1,500% since, more than Berkshire Hathaway itself. So he's made bad calls before. And you also have to understand that the risk management of billionaires is a lot different than the risk management of your 10, 50, $100,000 portfolio. For them to sit at 5% interest with 0% risk in a time of a lot of uncertainty at $280 billion, it's not a bad deal at all. Why not? Right? So the risk management of a multi-billionaire is a lot different than your portfolio. The other thing I want to talk about here, now that we have eliminated Buffett as an indicator of how you should be managing your portfolio. Buffett does his thing, you do your thing. It doesn't mean anything. People who blindly follow Buffett are not investors, right? So Buffett aside, let's talk about the Sam rule. So the Sam rule, never been wrong before, absolutely true. But number one, Claudia Sahm, she has a wonderful Substack, and I suggest you guys check it out. Claudia Sahm herself, the inventor of the rule, literally came out and said a few days ago, hey guys, this year might not be a good year to apply this rule. It might be actually different, because unlike all the previous times when this rule was applied, right now we are dealing with a lot of immigration over the past few years, a lot of illegal immigration, a lot of legal immigration. So the amount of immigration into this economy has created a skewed data in which unemployment is rising, but it doesn't have any structural issues with the economy that's leading to that. So it's happening because of excess working force, but not any structural problems with the economy. So she's basically saying, look, if there's a year where this isn't going to be 100% accurate, this is the year. So that's one. Number two, if you look at the data, since 1950, the Sam rule was triggered 13 times, right? And all of them predicted a recession before or after, no doubt. But 6 out of the 13 times, 50%, right? 50% of the time, the Sam rule was triggered at the bottom of the market. So 50% of the time, when the Sam rule was triggered, we were at the bottom right before the spike. And the other 50%, it saved your ass, no doubt. The prime example is 2000, 2008. If you sold out when the Sam rule got triggered, you saved yourself a world of trouble. 50% of your portfolio would have been gone. But if you sold out in 2020, then you missed out the entire rally that we've seen in the post-pandemic. So what I'm saying here is that the Sam rule is good at predicting recessions before or after, but it's not a good prediction tool about what the market is going to do once the rule is triggered. It's literally a crapshoot. It's 50-50. So it's not a good predicting tool as well. So the conclusion here for you guys is very simple. There's no shortcuts. I know everybody wants a shortcut. Oh, Tom, give us a formula, something that we know that 1 + 1 = 2, and then we can do exactly what 2 means. Buffett is selling can mean a bunch of different things. Unemployment data can mean a bunch of different things. Claudia Sahm says her rule might not be accurate this time. The rule has been literally 50% on and off over the past 60, 70, 80 years, whatever that may be. Buffett has made a lot of mistakes. And even if you look at the macro data, there's a lot of good stuff, there's a lot of bad stuff. You have high unemployment, you have high rates, right? But on the other hand, you have high growth of GDP, 2.8%. You have 3% inflation. Consumer spending is 2.3%, is higher than it was a quarter ago, significantly. 80% of companies are beating earnings per share. There's a lot of arguments in both directions. So my conclusion is there's no shortcuts. You got to do the work yourself. The market can crash, definitely, or it can soar, definitely. There's no way to catch it. There's no way to time it. And the other thing you need to understand that you have red days to remind you that my clients, my students, they know this. When we feel pleasure because our portfolio rises, that's fine. But the pain we feel from the same percentage of a drop is much, much stronger. Plus 1% gain equals minus 0.5% of loss. So the red days, they feel much more painful than the green days. Especially if you look at the fear and greed index, look at how volatile it is. Just 2 weeks ago, we were in greed. Now we're in fear, flirting with extreme fear. Short term sentiment is a volatile thing. Emotions are bad for you as investors. There's always reasons to sell. Over the past 80 years, there were plenty of wars and crises and recessions and depressions. There was always a good reason to sell out of the market, always. But at the end of the day, if you look at the past 80 years, dollar cost averaging into the market slowly over a long period of time has always been better than trying to catch a falling knife or catch a rising market or to literally time the market. Timing the market doesn't work. DCA works regardless if the market goes up and down. I showed you yesterday. If the Fed cuts the rates in September, which it probably will, and we don't know if the economy is good or bad. We'll find out in a few months. But if the Fed cuts rates and we find out that we were in the recession, then it's going to take us 2 years, but we're going to be back where we started. So you literally lose nothing but upside, right? But if the economy is actually better than what we think right now, and it's not a recession, then we're going to do 40% in 12 months. And if you sell out, you might miss that 40%. If you stay and the market crashes, well, you're back in 2 years to where you are right now. That's what I'm saying, that staying in the market, regardless of what the direction is always the better option as long as you DCA slowly and don't do crazy stuff. All I'm saying, thank you so much. I'm going to head right there to the beach. I'll see you hopefully when I get back, unless some crazy stuff keep happening. Later.